Last night, the Fed made its call, and the headline everyone is repeating, no rate hike, is not the real story. The real story fits in just 4 words. Tough talk, soft hands. Today I will show you why the Fed did not choose to pause. It had no choice. The Fed just held the federal funds rate at 3.5 to 3.75%. Now why does that matter? Because the interesting part is not the hold itself. It is what the hold quietly reveals. Why did not they hike? 3 words, they cannot afford it. And there are exactly 3 parts of the American engine that simply break if rates go up. Reason 1. The Treasury market cannot take a hike. US government debt is on track to blow past $40 trillion this autumn. At that size, every quarter point of rate adds enormous refinancing pain for the Treasury. And here is the scarier part. America's biggest holders of that debt are its own commercial banks. If bond prices keep sliding, the banks cannot stomach the losses. Remember Silicon Valley Bank? That one got blown up by rate hikes. The Fed definitely remembers. Reason 2. The manufacturing comeback cannot take a hike. Washington is begging TSMC and Samsung to build fabs on US soil. But reshoring has one hard precondition. Financing costs cannot be high. Factories, equipment, land, all heavy assets. Higher rates kill the urge to invest. So you are shouting, bring industry home with one mouth and pushing rates up with the other. Tell me, how does reindustrialization ever land? Reason 3. The AI buildout cannot take a hike. America's sharpest spear right now is AI data centers, power plants, grids, all of it runs on gigantic capital spending. One estimate says AI-linked investment drove roughly 75% of US GDP growth in the first quarter of 2026. If the Fed had actually hiked, tech valuations would have been squeezed, and America's strongest growth story gets interrupted by its own central bank chief, Kevin Warsh. So Warsh could not sacrifice the country's strategic advantage just to prove how hawkish he is. When he sat at that table, he chose the bigger interest, hold. Now, what does this mean for your portfolio? First, tech. For tech to keep climbing, the hike expectation has to fade. The recent global tech sell-off? Its core pressure was Warsh's hawkish signals, because tech value is just future profits discounted to today, and higher rates cut that discount and crush valuations. This hold means the most direct bearish catalyst has landed. But do not misread it. That is not a green light for tech to rebound tomorrow. The headwind is weaker, not gone. Second, Hong Kong. Liquidity pressure eases in the short term. The Hang Seng's money is heavily foreign-driven. Strong dollar, pressure, weak dollar, the market finally breathes. But Hong Kong will not rally just because the dollar relaxes. It needs China's economy to show real support, and its core assets to actually repair their earnings. Third, A-shares. The play is not the most crowded tech track. It is the low, unloved sectors with policy expectations. China's first-half exports were strong. Domestic demand and investment weak. If the yuan stabilizes or even strengthens as the dollar softens, Beijing's monetary room opens. RRR cuts, rate cuts, structural tools all get more space to stimulate. And who wins that? Not the leveraged, over-owned tech names. It is the cheap, cash flow stable, long-shunned old economy sectors. The old lamps the market forgot. When the mood shifts from killing valuations to hunting for policy support, money goes to what is cheap, stable, and expected. So the real verdict from July's meeting, the hike scare is off, and global assets finally have the conditions to stop falling and stabilize. But, and this matters, they do not yet have proof of a full bottom. Here is the part that actually protects you. Do not rush in just because you saw the news. News tells you the wind may have shifted. It does not tell you the bottom is in. Position management beats guessing every single day's move. So that is the Fed's real message, tough talk, soft hands, and a market that can finally breathe. If this breakdown gave you an edge, smash that subscribe, and I will see you in the next one. This is Alex.